Hello everyone, welcome back to the channel. Today we're going to be going through the Pressure Toolkit. This is our new indicator that's available on our website. It's only available on the ATAS trading platform and it is currently released. So if you're interested, please check the link in the description. Now this is called the Pressure Toolkit. The reason we named it Toolkit is because it consists of a combination of different analysis techniques to spot buying and selling pressure. The main goal of this indicator is to give traders context. It shows you exactly where passive and aggressive orders are coming in, and it helps you read what's actually happening in the price using live order flow. Now, to begin with, I'd like to go through each feature of this indicator and then demonstrate some examples on how to use this tool in practice. So if you wish to see real trade examples on how this toolkit can be utilized in day-to-day trading, please skip forward to the end of this video. But let's begin with the different signals this toolkit produces and what they mean. So let's start with the pressure bubbles. These pressure bubbles, what they represent is aggressive market orders, right? So the green bubbles is going to be our aggressive market buys. The red bubbles are going to be the aggressive market sells. Now, these bubbles can vary in transparency. So some of them are brighter than others. As you can see, here's some semi-transparent ones. And the brighter ones are just a little bit more significant. They just represent a little bit more buying pressure than the semi-transparent ones. And in many ways, they can be stronger signals for entry. Now, importantly, these bubbles are not buy or sell signals. They can be used for entry, and I do use them for entry, but all they do is show you where the orders are being placed. So you don't need to enter every single bubble signal. As you can see, some of them won't be good entries, but they can signify the start of major trends, and they can signify the start of, big bear moves or big bull moves. But the main thing is they just represent the aggressive market buys and the aggressive market sells. Now, if we go into our settings, this will be the first group that you will see, the pressure bubbles group. Now, the first thing you'll see is the engulfing candles filter. You can toggle this on, and what this will do is, if you see pressure bubbles on, doji candles, this will filter them out. And the reason being is personal preference. If you want to see, aggressive market buys or aggressive market sells only on strong, engulfing candles, then this filter might be for you. Because the pressure bubbles on those candles are a little bit more significant in my experience. If you see engulfing candles with solid aggressive buys or aggressive sells, these are usually good signals, and they're a little bit more significant than the candles that have very long wicks and candles with not a really great structure to them. So if you want to use this filter, you can control the size of the engulfing body. So the closer you get to 1, the more engulfing the candle will be. So if you set this to 1, it will only show you candles with pressure bubbles that are completely engulfing candles. They don't have a lower wick or an upper wick. So by default, this is set to 50%, which just means that 50% of the candle size is the candle body. I personally don't keep this on, but if you want to, it's there. The next thing is going to be our show big trades feature. Now, the big trades, you might have noticed it already, is a little highlighted rectangle on each candle that shows you the biggest trades in the market, and it will have text below it with a label of the order volume. These big trades are controlled by this big trade threshold. So this 5 represents the top 5% big trades in the last 100 bars. So you can control these settings. You can control the look back period. And if you want to see, for example, the top 3% big trades in order volume in the last 100 bars, well, then you would set 3 here and 100 here. The look back period is the last 100 bars, and the percentage is the top 3% in order volume in the last 100 bars. And it's kind of an adaptive indicator feature that shows you the biggest trades in the last while. Now, these big trade signals can be used for entry. If you're at the bottom of a range and price is not overbought, like here, we get a big trade signal that caused a bullish rally and price went up. So you can use them for entries, and the other thing you can use them for is signals of exhaustion. And what I mean by that is when price becomes overbought and you see a big bullish trade, like this one, for example, this can actually signal exhaustion, because this is not a good entry. This is not a good long entry, because you're at the top of the price is already overbought. You missed the bull move. The bull move already occurred. And if you get a big bullish trade at the top of the range, this is actually a warning that price might pull back, or that it might just completely reverse, right? So this is actually bullish exhaustion. There are just no more buyers to come in, and the buyers have been exhausted. And you'll see this time and time again, where the big trades at the top of the range, the big bullish trades, will result in a pullback or a reversal. And the same can be said for the big bearish trades. As you can see here, there's a big bearish trade up here. That would actually be a good entry for a short position. But at the very bottom of this range, the bear move already happened. And then we get a really big trade right down here. This is selling exhaustion. This represents a lot of selling at the bottom of the range where price is already oversold. So this is a really bad short entry. If you did enter short here, you would lose. This warns you that there might be a pullback or a reversal coming up. And you will see this time and time again. The big trades at the top or the bottom of the range are often warning signs. So the next thing is our alert section. So for every single signal, you can get an alert. So the bull bubbles, for the bull bubbles or the bear bubbles, you can get alerts for those. And of course, for these big trades, you can toggle this on. If you want to see alerts, you will get a sound notification for when these signals appear live. Now, the next signals that this toolkit produces is our absorption signal. So this is our passive buying and selling. So we covered our aggressive market orders. Now we want to cover our passive limit orders. Where are people placing limit orders? Where is the liquidity in the market? And when does price react to that liquidity? So to see this is all in our absorption section here. And I've toggled these signals on. So we have our absorption dots and our absorption lines. In total, there are 3 different signal calculations used for detecting absorption. So these signals represent passive orders. So let's go through them. The first signal type is our absorption dots. And these are the small absorption dots that you'll see on the chart. And what these represent is intrabar absorption. That means on this particular candle, there is absorption, which means that the sellers tried to push the price down, but they got absorbed by passive limit orders. And it's really important that you understand that this is only intrabar absorption. So out of the 3 signal calculations, this is probably the weakest absorption signal, but nonetheless, it is quite important and it can be of use. When we go into our absorption settings here, you can control these dots using the absorption threshold. And I'm not going to go through all the calculation of this, but if you want to see more of these smaller dots, you can reduce this, you can decrease this value, and you will get more dots on your chart. But the default value should be fine. Now let's move on to the second absorption signal. The second absorption signal is the larger absorption dots. Now the larger absorption dots, in order for these to plot on your chart, the small absorption dot should also be present here. But that doesn't mean that the calculation methods is similar. The calculation methods for these larger absorption dots is actually different, and it uses a look back period, which is here, of 100 bars by default. So it looks at the last 100 bars and it compares absorption across those bars, and it only marks out the most significant absorption. So the smaller dots is intrabar absorption, and the larger dots actually take into account the history of the volume and the other absorption in the last 100 bars. And you can also alter the absorption threshold. So if you feel like you're not getting too many large dots, you can reduce this to 1 or 1.5, and you will see more of these signals. So the default value should be fine, but you can play around with it if you feel like you're not getting enough large absorption dots. Now, the next absorption signal is our absorption lines. Now, really importantly, These are green lines, but this is actually a bearish signal. Not to get confused with the colors, the green lines are actually bearish absorption and the red lines is actually bullish absorption. The reason this is red is because this actually represents trapped sellers. So how this is calculated is it finds a lot of strong sellers that were unable to move price downward and price closed above it, which creates this trapped seller signal. It is actually one of my favorite absorption signals out of the tree. But importantly, if you do want to reverse the colors and have bullish absorption be green, you can do that in the drawn section of the indicator settings. Now, the next feature is our psychological levels. So these levels are represented by these horizontal gray lines that are marked out at each psychological whole number prominent level. And the reason we have this feature is because price often likes to react at these levels. Whether it's support or resistance, there's often a lot of activity at these levels, and people actually target these levels for profit taking or for setting stop losses. Either way, you will find liquidity at these levels. So guys, how can we utilize this toolkit and how do we implement it into your strategy, into your day-to-day trading? Well, one of my favorite ways to use this toolkit is with Confluence and with additional analysis tools such as the CVD, which is our cumulative volume delta indicator. One of my favorite tools in all of ORDERFLOW. You guys know this if you watch my videos. It basically shows you the difference between the buyers and the sellers, and it can really paint a picture on where price is going next. Additionally, you can combine this with support and resistance and other tools that establish prominent and important levels in the market, such as our psychological levels feature in this indicator. Also the volume profile, which will show you the highest volume traded at each specific level, and it will mark out the point of controls, the value area highs, the value area lows in the market. So for me, the main levels that I watch out for where certain reactions might be more important is the prominent levels, the psychological levels, it's the absorption line levels, and the levels from our support and resistance indicator. That simply shows you the swing highs and swing lows, but they can be very important. So you do want to watch for reactions at these levels. I mean, here's a good example. Price broke this 23.75 level. When it tried to retest it, we got 3 separate absorptions at this level, meaning that there was limit orders here and the passive orders pushed this price further down. Price couldn't break it and we got absorption every time price did try to break it, but it failed to do so and it went down. For the passive orders and the aggressive orders, my favorite combination is absorption quickly followed by aggressive market orders. Now, what do I mean by this? I mean, for instance, here's a great example of bullish passive orders. So this is bullish absorption right here, followed by aggressive buying pressure in the form of a green pressure bubble. What does this mean? Why is this important? Well, this just tells you that there's bullish passive buyers and bullish aggressive buyers almost at the exact same time entering the market. And this is often a much stronger signal than your standalone pressure bubble or your standalone absorption. When you see bullish passive orders followed by bullish aggressive orders, that just means that there's a lot of buying sentiment there. And this is a signal worth listening to. And it's a much more powerful signal than any standalone signal. So this is actually one of my favorite ways to use this toolkit. As you can see here, we got some bullish absorption followed by bullish aggressive market orders and price went up. This would have been a great area to go long. And then we use Confluence to confirm this. Does this long entry make sense? Does the delta confirm it? Yes, it does. Why? Because price made a low here, it made a higher low here, and the delta made the exact same move. There's a low here in the delta with a higher low here in the delta. The delta is starting to go up here, right? So the sentiment is changing. The price is going up. It coincides with the delta. Usually when the price and the delta move in the same direction, that's a good sign that the trend will continue in that direction. So we got bullish absorption, we got aggressive market orders, aggressive buys. So this is what I look for. I look for absorption, and on the very next candle, aggressive buys coming in. Sometimes a candle over is okay, but you know, to have a perfect trade, you want it on the very next candle. The same thing happened here. We had bullish absorption followed by aggressive buys. And honestly, that would have been a completely fine entry too, as long as your stop loss was below this support level maybe. So let's just see what happens next, right? So we go up to 23.75. There is actually bearish absorption there. So perhaps people were exiting positions, but it did break that level. And then again, we got bullish absorption right here on this candle. Price tried to go below 23.75. This is a prominent psychological level, but it got absorbed. So there's clearly passive buyers here that absorbed the price on this intra-bar absorption. And then right after that, we got aggressive buyers. So again, we got the same combination. We got passive buyers, aggressive buyers. A long entry here would have been really, really good. And price went up. Again, we got more bullish absorption here. We have a resistance level here. This is from this indicator. But price broke it quite easily. And price continued higher. So delta is increasing. This is a really bullish trend. This delta is extremely bullish. I would like, here we reach another level of absorption lines. So this is a potentially resistance level, but I would never in my life think that the price will reverse in here because of this delta. The delta is way too bullish. The negative delta is almost non-existent. There's no aggressive selling here. So this might be a resistance level and people might take profit here due to all this absorption, but price did not go down and it actually ended up going higher. So more absorption here, aggressive buying, and then another move upward. So where do we actually take profit? Well, you can take profit at these prominent levels. At any resistance is usually a good idea. But then here's what happens. This is actually quite interesting. Remember what I said about big trades at the top of the range? So if we get the big bullish trades at the bottom of a range, you know, if we got a big trade here, it would have been a nice long entry. But because this bullish move already occurred and price is becoming overbought, this is buying exhaustion. Like I mentioned earlier, if you get big trades, you know, big bullish trades at the top range where price is already overbought, this is actually a warning sign that price might pull back or reverse. And it did pull back. Not drastically, but it did pull back. We actually hit resistance level here. It was broken, but then we see multiple levels of absorption. We get a big trade. So buyers are getting exhausted here. We get absorption. This would be actually a great place to exit your long position, you know, if you were long. This is a warning sign that something might pull back. The price might pull back here, and you need to be wary of that. So price did pull back. Delta is still, the negative delta is weak. I mean, this could be the start of a bear trend, but to me, this is still quite bullish. The delta is uptrending, the price is uptrending, and we did not get absorption at a prominent level. So to me, I would look for more longs. And here's a great example. We got more significant absorption followed by aggressive buying, more significant absorption, aggressive buying, and price went higher. So you could have taken another long off of here or off of here. Both would have done you a lot of good. So this went higher. We got more absorption here. So this just tells you that sellers are trying to push the price down. They're getting absorbed by passive orders. So the passive buys are pushing the price up. And as you can see, more bullish absorption here, keeps going up. We're hitting more levels, we're breaking those levels. And then we come up to this level. This is 24,000. There's a reaction at this level. So again, psychological whole number. People are going to exit their positions at this level. And clearly, this was an important level where price did react more drastically than before. There's no absorption here and there's no aggressive selling. So this is not an area I would enter into a short position, but this is probably a good area to get out if you were in a long position back here. So what happens next? The delta actually starts to trickle down a little bit, looks a little bit different now. So at this point, I would be wary of going long because the delta looks different. This is a major pullback now from a 24,000 prominent level. at this point, you need to think about going short, perhaps. But there's no good signals to go short. There's no bearish absorption. There's no aggressive selling following absorption. So we actually see bullish absorption here with another big order at the bottom of our range. Absorption and aggressive orders on the same candle. See, the delta doesn't look strong to me, so I don't know if I would go long here. I probably wouldn't. But this actually ended up being a good signal to go long. Oh, here actually is a better place to go long. So this is not a good long, in my opinion. In my books, I wouldn't enter this. It turned out to be good, but actually here, once you get to this point, the delta starts to increase again. So that's a good sign. We didn't break any lows, so there's no market structure breaks. Price is still making higher highs, higher lows, right? So at this point, delta is actually starting to increase again. Although it was trickling down, now it's starting to increase. We get some aggressive buying, we get absorption, it pulls back a little bit. Then we get more absorption and a really strong delta candle and aggressive buying. So the combination we're always looking for is passive buying, aggressive buying on the next candle. And as you can see, another pump. We broke this absorption line level. It just kept pumping, really strong buying here. As you can see, it just pumps all the way up to a strong resistance level from our support and resistance indicator. What else is at this level? Well, the weekly point of control is here. So there's absorption at this level. Clearly, this is a level of interest that you should be wary of. If you are long here, you might want to exit around here because there's a resistance level. You know, there's the point of control here. These are levels where price reacts. It likes to reverse at these levels. And we do get some absorption, you know, not the strongest absorption I've ever seen, but there is absorption here at this level. There is aggressive selling at this level. And I would not go short here because we're in a really strong pump. But as you can see, price did pull back here. So the delta started to change. And you just need to be careful about, you know, entering longs really high up in the price. Now, one thing to note before you start trading, guys, if you load the toolkit up onto your chart and you see something like this, you know, this looks like craziness because it's way too noisy. There's way too many signals. The likelihood is that you have too many price levels in your footprint charts. We zoom in into our candles. This is way too many price levels, and this is what's creating all the noise. So I'm on NQ right now, and as you can see, each candle consists of way too many price levels, and what we need to do is get rid of all the null values and all the unnecessary data that we don't need. And we can do this by changing the scale in the top right, or usually by changing the time frame. Well, what we're going to do is change the scaling. I have it set to auto. So if you go from auto to, let's say 4, that will reduce a lot of that noise and you'll get much clearer signals. And as you can see, the footprint data looks a lot more appropriate, a lot more adequate now. And that's kind of what you want. So guys, that will be it for today's video. Please tell me if I missed anything, any important information that you'd like to know about, or if there's video ideas that you'd like to see in the future. Tell me what you would like to see in terms of using this indicator, and any advice or suggestions. I'd really appreciate your input, guys. Again, if you'd like access to this indicator, please visit our website. The links will be in the description, and I'll see you in the next one very soon, guys. Take care.